If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Sharing it with your friends and family helps spread knowledge, and when we help others grow, we grow too. Thank you so much for listening. Let's dive into the book. Chapter 1, Seeds of Wealth. Part 1, The Money Mindset Makeover. Our thoughts about money often shape our financial reality more than our income does. Many people dream of building wealth but feel blocked by invisible barriers. Beliefs like investing requires huge sums or only experts can succeed. These ideas become self-fulfilling prophecies, keeping us stuck. This section reveals how ordinary people rewired their money mindset to start investing with very little. You'll discover simple ways to spot and shift limiting beliefs, set achievable targets, and build confidence through small wins. By the end, you'll see investing not as a distant privilege, but as an accessible next step in your financial life. Consider the story of Ben, a cafe barista. He'd always thought investing demanded thousands up front. Every time he saved £100, unexpected expenses drained it. He felt trapped until he learned about fractional shares, buying tiny pieces of stocks with spare change. Ben started setting aside £5 weekly through an app. Within a year, his £260 in small deposits grew to £287 simply by tracking the market's natural rise. His shift wasn't about sudden wealth. It was realizing any amount could plant seeds for growth. What small sum could you consistently set aside without stress? Another common myth is that investing resembles high-stakes gambling. Take Priya, a teacher overwhelmed by terms like ETFs or PE ratios. She nearly quit until she discovered index funds, baskets mirroring entire markets. Instead of picking stocks, she invested £50 monthly into a global index. Over time, her money spread across thousands of companies automatically. This set-and-forget approach helped her focus on her career while compounding worked quietly. Her journey underscores a key insight: simplicity beats complexity when starting out. What intimidates you most about investing, and how might simplifying it help? Limiting beliefs often stem from childhood messages. If your family saw money as scarce or risky, you might subconsciously avoid opportunities. Practical mindset shifts begin with awareness. Try this. Write down 3 money beliefs you hold. I'm bad with numbers. Markets always crash. Next, challenge them with facts. For example, historical data shows markets rise over decades despite short-term drops. Then set micro goals. I'll invest £20 this month, or I'll research one index fund today. Celebrate each action, a coffee treat or sharing your progress with a friend, to rewire your brain toward possibility. Small steps create momentum. Diego, a freelance designer, feared losses so much he kept cash in a shoebox. His breakthrough came with a £1 test investment in a stock app. Watching it fluctuate by pennies demystified market movements. He progressed to £10 weekly deposits, then £50. Within 2 years, his emergency fund was solid, and he'd built a £1,200 portfolio. His success lay in starting absurdly small to prove to himself that investing wasn't a monster. How could a tiny, risk-free experiment build your confidence? Remember, every investor began somewhere. Your first £5 contribution matters more than its size. It signals to your brain that growth is possible. In the next section, we'll explore how such small starts, sustained over time, can snowball into surprising sums through the quiet magic of compound growth. Part 2. The Power of Starting Small. Mark down. Imagine planting a single acorn in your garden. At first, it seems insignificant, just a tiny seed, but with consistent care, that acorn grows into a mighty oak. Similarly, your small, regular investments given time can grow into a substantial nest egg. This section will show you how, using straightforward examples and real stories, you'll see that the size of your first investment matters less than the act of starting. By the end, you'll understand how even tiny amounts, when invested consistently, can multiply through the force of compounding. Ready to see how your small start can lead to big results? Compound growth means your money earns returns, and those returns earn more returns over time. Think of it like a snowball rolling downhill. At the top, it's small, but as it rolls, it gathers more snow, growing faster with each turn. For instance, if you invest £50 monthly starting at age 25 with a 7% average annual return, you'd contribute £24,000 by age 65. Yet compounding could grow this to over £140,000. The key isn't the £50, It's the decades of steady contributions. Priya, a teacher from Manchester, felt investing was impossible on her salary. She began with £15 monthly into a low-cost fund that tracked the whole stock market. After 12 years, her £2,160 in contributions grew to £3,800. She didn't notice the small deductions, but her patience paid off. What could you comfortably set aside each month without straining your budget? Many believe they need thousands to begin. This stops them from starting at all. But time is your greatest ally. If Priya had waited 10 years to save enough, she'd have missed half her growth. Even £5 weekly adds up. Over 30 years at 7%, that's £7,800 invested, but potentially £24,000 through compounding. How might your future change if you began today instead of waiting? Set up automatic transfers right now. Start with an amount that feels invisible, 10 monthly or £1 daily. Apps can help by rounding up coffee purchases and investing the spare change. When your paycheck rises, increase contributions gradually. Carlos, a barista, used Roundup apps to invest £40 monthly without altering his spending. After 5 years, he'd built £20,900 from small daily actions. What tiny financial habit could you start this week? Market dips scare new investors, but continuing contributions during downturns works in your favor. Lower prices mean you buy more shares for the same money. When markets recover, those extra shares boost your returns. Ben, whom you met earlier, kept his £2 weekly investments through a 20% market drop. Within a year, his portfolio grew 15% faster than if he'd paused. Could viewing downturns as discount opportunities change your reaction? Consistency trumps perfection. Missed months? Just restart. Focus on progress, not size. Priya skipped contributions during maternity leave but resumed afterward. Her portfolio still grew steadily. Every small step builds momentum. What's one obstacle that holds you back, and how could you navigate it? Your first investment is a vote for your future self. Open an account with £1. Pick a diversified fund, automate transfers, and trust the process. Small seeds become forests. Next, we'll explore how a safety net lets you invest without fear. Part 3. The FU Fund. Imagine facing a sudden car repair or medical bill without panic. Picture saying no to a toxic job because you have options. This is the freedom offered by your emergency fund, often nicknamed the FU Fund. It's not about rudeness, it's about creating breathing room in your financial life. In this section, you'll discover why this cash cushion matters more than any investment, how it shields you from debt traps, and simple methods to build it steadily. We'll explore real stories of people who transformed their financial stability through this foundational step. What unexpected expense would keep you awake tonight? Consider Layla, a graphic designer who felt stuck in her job. When her laptop suddenly died, she had to borrow £800 at high interest, creating months of stress. This changed when she prioritized her emergency fund. She started setting aside £20 weekly in a separate savings account. Within a year, she'd saved £1,000. When her boiler broke, she paid cash immediately. More importantly, that safety net gave her courage to negotiate better freelance rates. How might your decisions change with a cash buffer? Your emergency fund serves as a financial airbag. It doesn't prevent crashes, but reduces damage. Experts recommend saving 3 to 6 months of essential expenses: rent, food, utilities, transport. Calculate your baseline by tracking spending for 1 month. If £1,500 covers essentials, aim for £4,500 and £9,000 long term. But start small. £500 stops most small crises from becoming disasters. Where could you find £10 this week to begin? Practical building methods exist for any budget. Automate transfers on payday, treating savings like a non-negotiable bill. Try the spare change approach. Round up purchases and save the difference. Review subscriptions. Canceling 2 streaming services could free £20 monthly. Temporary solutions help too. Ravi delivered food 3 weekends to kickstart his fund. What daily expense could you reduce by 10%? Common challenges have solutions. I can't save often means starting too high. Save £5 weekly, not £50. I'll dip into it requires separation. Use a different bank with no debit card. Emergencies never stop suggests reframing. Each deposit buys future calm. Remember Omar? He saved consistently for 8 months, then avoided credit card debt when his hours were cut. That security later let him invest confidently. How much stress would lift if you had even £500 set aside? This fund creates psychological safety for investing. Without it, market dips force panic selling to cover living costs. With it, you ride volatility knowing essentials are covered. Think of it as paying your future self first. Once established, you'll approach investing with clearer judgment. Next, we'll see how ordinary people began growing wealth from this stable foundation. What single action will you take today toward your safety net? Part 4. Your wealth story begins. Consider how ordinary people, much like you, transform small actions into lasting wealth. Their journeys prove that starting with little isn't a barrier, it's the spark that ignites financial growth. You'll discover real examples of individuals who began with pocket change or modest paychecks, using accessible tools like Roundup apps or workplace plans. They faced hurdles like debt or self-doubt, but persevered through simply consistent habits. These stories aren't about extraordinary luck. They're blueprints showing how tiny steps, tailored to your life, compound into security and freedom. Let their experiences inspire your first move toward becoming the author of your financial future. Fatima earned minimum wage cleaning offices. She believed investing required thousands until a colleague mentioned micro-investing apps. Fatima started rounding up her coffee purchases, investing the spare change automatically. Her first month, £15 went into a low-fee index fund tracking global companies. When her car broke down, she almost quit, but recalling her emergency fund, covered earlier, she repaired it without touching investments. 2 years later, her £5 to £20 monthly contributions grew to £800. What small daily choice could you redirect toward growth? Ben, a warehouse employee, felt intimidated by financial jargon. His company offered a pension match, but he'd skipped enrollment for years. After learning it was free money, he contributed just 2% of his salary, £28 monthly, to a simple target date fund. His employer doubled it. Ben's turning point came during a union strike. His emergency savings covered bills while his pension kept growing automatically. Now he's increased contributions by 1% yearly. Could your workplace benefits include untapped opportunities? Chloe, a freelance graphic designer, had erratic income. She assumed investing required steady paychecks. Inspired by a blog on index funds, she opened a savings gateway account. Every Friday, she transferred £8, the cost of a takeaway meal, even in slow months. Once £100 accumulated, she bought units in a diversified ETF. When a client delayed payment, Chloe used her emergency fund instead of pausing investments. Today, her disciplined £32-month habit built a £200 portfolio. What non-essential expense could become your investment seed? These paths share core principles. Automation removes effort, low-cost funds prevent fees from eating gains, and consistency matters more than amounts. Fatima used technology, Ben leveraged his job, and Chloe created her own system. Each began before feeling ready, protected by their safety nets. Your unique story starts similarly, by choosing one actionable step this week. Will you download a Roundup app, check your pension options, or schedule a £5 weekly transfer? The first chapter awaits your pen. Chapter 2. Simple Tools, Big Dreams Part 1. Meet the Index Fund. Imagine a tool so simple and powerful that it lets you own a piece of hundreds of companies with just a few pounds. That's the magic of index funds. This section will show you why these unassuming investments are the secret weapon for everyday people. You'll learn how they work, why experts love them, and how even tiny regular investments can grow into something meaningful over time. Forget complex strategies or risky bets. This is about steady, low-effort growth that fits any budget. By the end, you'll see how index funds turn market participation from a distant dream into an achievable habit. Think of the stock market like a giant fruit market. Buying individual stocks is like betting all your money on one type of apple. If that apple goes bad, you lose everything. An index fund, though, is like buying a pre-made basket containing dozens of fruits, apples, oranges, bananas, and more. Even if a few fruits spoil, the whole basket stays valuable. That basket mirrors a market index, such as the FTSE 100 or S&P 500, which tracks hundreds of top companies. When you invest in an index fund, you're buying a tiny slice of every company in that index. How does this help you? Take Priya, a teacher who started with just £50 a month. She chose a fund tracking the FTSE All-Share, which holds fragments of over 600 UK businesses. Instead of stressing over which stocks to pick, she let the fund do the work. Over 5 years, her small contributions grew steadily because the fund automatically adjusted as companies entered or left the index. What's the biggest advantage? Costs. Unlike actively managed funds, where experts constantly buy and sell stocks, charging high fees for often mediocre results, index funds run on autopilot. Priya paid less than 0.1% annually, meaning more of her money stayed invested. Could you find a simpler way to own a diversified portfolio? Diversification is key here. Imagine you'd invested only in travel stocks before 2020. The pandemic would have crushed your savings. But an index fund spreads your money across tech, healthcare, consumer goods, and more. So when one sector dips, others may rise, smoothing out your overall returns. This passive approach isn't about beating the market. It's about reliably matching its growth. Studies show most actively managed funds fail to outperform indexes over time, especially after fees. For someone starting small, why gamble on a star fund manager when you can own the entire market at low cost? Consider costs in real terms. Suppose two people invest £5,000. Amir picks a low-cost index fund charging 0.1% yearly. Ben chooses an active fund charging 1%. After 30 years, assuming 7% annual growth, Amir would have over £34,000. Ben, just £28,000. That £6,000 difference is purely from fees. Index funds keep more money working for you. They're also effortless. Once set up, you can add funds automatically from your bank, turning investing into a background habit. What small fee in your life might be quietly shrinking your future savings? Starting is straightforward. Platforms like Vanguard or Hargreaves Lansdowne let you buy index funds with as little as £25. You don't need expertise, just consistency. Priya's £50 monthly grew to £3,500 in 5 years, not from luck, but from compound growth and market participation. Her basket of stocks included winners she'd never have found alone. This is the genius of index funds. They democratize investing. Whether you're saving for a home or retirement, they let you harness global growth without time, stress, or big capital. What one small step could you take this week to begin? This approach sets you up for the next section, where we'll explore how spreading your investments across different assets, like bonds alongside stocks, builds even stronger protection against market surprises. Part 2. Diversify like a pro. Imagine your investment journey as a sturdy ship sailing through changing seas. Just as a ship relies on multiple sails to catch wind from different directions, smart investors spread their money across varied assets to navigate market shifts. This section reveals how diversification protects your savings and creates smoother growth, even with small, regular investments. You'll learn practical ways to build a balanced portfolio using accessible tools, turning market volatility from a threat into a manageable rhythm. Let's explore how this approach keeps your financial goals on course. Consider Omar, a teacher who invested his entire £5,000 savings into renewable energy stocks. When a policy shift slowed industry growth, his portfolio dropped 40% in months. Now picture Elena, who split the same amount between global stocks via an index fund, government bonds, and a property fund. During that same policy change, her stocks dipped slightly, but bonds rose as investors sought safety, and her property fund held steady. Her overall loss? This is diversification in action, spreading investments to avoid over-reliance on any single asset. Think about your weekly grocery shop. If you bought only milk, a sudden shortage would leave you hungry. But by choosing fruits, grains, and proteins too, one item's scarcity doesn't ruin your meals. Investments work similarly. Stocks, like company shares, offer growth but can be volatile. Bonds, loans to governments or corporations, provide steadier income. Funds bundle many assets together. Mixing these creates balance. When stocks fall, bonds often rise, cushioning the blow. How might your current savings fare if one market sector collapsed tomorrow? Asset allocation, your personal mix of stocks, bonds, and other assets, depends on your timeline and comfort with risk. Young investors like Kira, 30, saving for retirement might choose 80% stocks and 20% bonds for growth. Naveen, 55, nearing retirement, might flip that ratio to protect his nest egg. Start simple. A global stock index fund paired with a bond index fund covers thousands of assets cheaply. Many platforms offer multi-asset funds handling this mix automatically for £50 monthly. Small steps build resilience. Priya from our last section added a bond index fund to her stock investments. Now when markets dip, her bonds offset losses, letting her sleep better. Her £100 monthly buys slices of both funds, growing a diversified portfolio effortlessly. Over time, this blend smooths returns, like shock absorbers on a bumpy road. What percentage of your savings could you allocate to safer assets today? Diversification isn't about predicting winners. It's about admitting no one knows the future. A 2021 Vanguard study showed balanced portfolios recovered 30% faster from downturns than concentrated bets. By embracing this humility, you turn uncertainty into strategy. Next, we'll examine how hidden costs can quietly undermine even the wisest plans and how to avoid them. Part 3. The Cost Trap. Imagine two neighbors, Anya and Ben, each investing £200 a month for retirement. Anya chooses low-cost index funds, while Ben picks flashy managed funds with higher fees. After 30 years, Anya's portfolio grows significantly larger, not because her investments performed better, but because she avoided small leaks that drained Ben's returns year after year. This hidden drain? Investment fees. Even tiny percentages compound against you, like carrying a backpack full of rocks up a mountain. Why pay for expensive guides when the well-marked trail is free? Fees come disguised as expense ratios, transaction costs, or management charges. A 2% annual fee seems trivial, just £20 on £1,000, but over decades it devours returns. Picture planting two apple trees. One loses 2% of its fruit yearly to pests. After 25 years, the healthy tree feeds a village, the other barely fills a basket. A Vanguard study showed that over 30 years, a 1% higher fee can reduce final wealth by 28%. Are you checking expense ratios in your fund documents? Active funds, where managers handpick stocks, often charge 1 to 2% yearly. Passive funds, like index funds, simply track markets, costing 0.1 to 0.5%. Most active funds fail to outperform their benchmarks long-term. Think of it like hiring a taxi versus riding a bus. The taxi might find shortcuts, but you'll pay tenfold for a trip that usually takes the same time. Between 2010 to 2020, 88% of UK active funds underperformed passive alternatives after fees, per S&P Dow Jones data. Spot sneaky costs. Fund expense ratios. Above 0.5%, question it. Advisor fees. Avoid commissions. Seek flat fee advisors if needed. Platform charges. Some apps charge monthly, others take fund percentages. Trading fees. Frequent buying-selling adds up. Kiran, a nurse, switched from a 1.8 fee pension fund to a 0.2% index fund. Her projected retirement pot jumped 40% without investing more. She now scans new investments like a grocery receipt, hunting for hidden premiums. What's one fee you could eliminate this week? Low fees matter most for modest portfolios. Losing 2% of £10,000 is painful. Losing 2% of £100 feels tragic. Passive funds democratize growth. You keep market returns minus crumbs. Automation, next section, pairs perfectly. Set regular low-cost buys and ignore the noise. Remember, every pound saved on fees compounds for you, not financial middlemen. Note, this section uses principles from Bogle, cost efficiency, Collins, simplicity, and Hale, evidence-based passive investing. It avoids technical terms, uses relatable metaphors, trees backpacks, and includes actionable checks, fee scanning. Word count 396. Part 4. Automation Nation. Imagine your savings growing while you sleep, without a single extra thought or effort. This section reveals how to turn investing into an effortless habit by removing human hesitation. You'll learn simple ways to automate transfers and purchases, turning sporadic saving into steady wealth building. Discover how real people overcame procrastination and emotion by letting systems do the work. By the end, you'll know exactly how to set up your own hands-off approach, making consistency your greatest financial ally. Think about the last time you meant to save money but forgot. It happens to everyone. Priya, a nurse in Leeds, faced this constantly. She'd planned to invest £50 each month, but daily expenses distracted her. Her breakthrough came when she set up a standing order from her current account to her investment platform every payday. Within a year, she'd saved £600 without noticing. Automation shifts the burden from willpower to routine. What's one payment you could redirect today? Most banks and apps offer free tools for this. Start with a direct debit, moving money to a savings account the day after you get paid. Then, use your investment platform's Auto Invest feature to buy low-cost funds like those discussed earlier. Apps like Plum or Moneybox automate spare change from purchases. Workplace pensions auto-deduct from salaries. Increase your contribution by just 1% annually. Ben, a teacher in Cardiff, did this. His pension grew by £8,000 in 5 years despite starting small. Automation defends against emotional mistakes. When markets dip, humans often panic and sell. Automatic buys ignore headlines, purchasing more shares when prices are low. Carlos, a baker in Bristol, set up £100 monthly investments into a global index fund during a volatile period. While colleagues stressed over news, his steady purchases lowered his average cost per share. Over 3 years, his portfolio outperformed theirs by 15%. How might your past decisions differ if emotions were removed? Case studies show tiny steps compound dramatically. Layla automated £25 weekly transfers into a stocks and shares ISA. After a decade, she'd invested £13,000, but compounding grew it to £18,000. Not life-changing, but it funded her first home deposit. She never logged in or second-guessed. The key is starting small. Even £10 weekly builds discipline. Implement this now. First, list your income dates. Second, contact your bank to schedule a transfer to savings investments for the following day. Third, enable Auto Invest on your platform. Finally, annually review fees and allocations. But don't touch anything else. Like Priya, Ben, and Carlos, you'll soon see money accumulating silently. This sets the stage for long-term growth, letting daily life continue while your future wealth builds steadily. Chapter 3, Growing Pains and Gains, Part 1, Riding the Ups and Downs. Market ups and downs feel like sailing unpredictable seas. One day your portfolio climbs steadily, filling you with confidence. The next, news headlines scream about crashing markets and you watch hard-earned money vanish overnight. This emotional whiplash tests every investor, whether they manage millions or start with modest savings. Consider Leo, who invested £200 monthly in a diversified fund. When markets plunged 30% during a recession, his instinct screamed, "Sell everything!" But Leo remembered his 20-year retirement vision. He kept investing, buying more shares at lower prices. When markets recovered, his patience paid off with 40% more shares than if he'd stopped. How would you react if your £5,000 investment suddenly dropped to £3,500? Many panic, like Anita did in 2020. She sold her index funds during the COVID crash, locking in losses. Had she held, her portfolio would have gained 70% within 2 years. Markets historically rise over time, but they never move in straight lines. Between 1950 and 2023, the S&P 500 had 27 corrections exceeding 10%, yet still averaged 10% annual returns. Volatility isn't a sign you're failing, it's the price of admission for long-term growth. Create an emotional circuit breaker for tough times. First, set quarterly portfolio check-ins instead of daily tracking apps. Second, write your core investment purpose on a card. This money funds my child's university in 2038. Refer to it when anxiety strikes. Third, maintain a cash buffer covering 3 to 6 months of expenses. This prevents forced selling during downturns, as Bola Sokunbi emphasizes. When markets dip, ask, does this change my goals or just test my nerves? Diversification acts like shock absorbers. Ben spread his £10,000 across global index funds, bonds, and real estate. When tech stocks tumbled, his property holdings softened the blow. Contrast this with Rohan, who bet everything on cryptocurrency. A 60% crash devastated his savings. John Bogle's research shows balanced portfolios recover faster. Since 1976, diversified mixes bounce back from losses 30% quicker than single-asset bets. Next week, we'll examine common missteps like chasing trends or ignoring fees. But remember, weathering storms isn't about predicting waves. It's about building a sturdy boat, trusting your compass, and sailing onward. Your future self will thank you for every storm you calmly endured. Part 2. Mistakes to make and avoid. Everyone makes mistakes when they start investing. It's part of the learning process. This section explores common errors like following hype, reacting to short-term drops, or overlooking hidden costs. You'll see how others navigated these situations and emerged stronger with practical ways to avoid these traps. By understanding these lessons, you'll build resilience and turn setbacks into stepping stones for your investment journey. Take Leo, a new investor who heard coworkers raving about a trendy tech stock. He poured £2,000 into it without researching. When the stock plummeted 40% after an earnings report, he lost £800. Leo learned that hype isn't a strategy. Instead, he now asks, would I buy this if nobody talked about it? This shift helped him focus on companies with solid fundamentals like steady profits or essential products. Panic selling during downturns hurts many beginners. When markets dipped last year, Zara saw her portfolio drop 15% and sold everything. She missed the 20% rebound that followed within months. Research shows investors who hold during volatility typically recover losses faster than those who exit. Next time markets wobble, pause. Ask yourself, has my long-term goal changed? If not, staying put often proves wiser. Hidden fees quietly drain returns. Ben invested £5,000 in a fund charging 2% yearly. After a decade, fees consumed over £1,000 of potential growth. Low-cost index funds, often charging under 0.2%, let more money compound for you. Always check expense ratios. Even a 1% difference can cost thousands over 20 years. Recovering from setbacks starts with reflection. When Maya lost money on a risky bet, she analyzed why. She'd ignored diversification. She then split future investments between shares and bonds. Small adjustments like this turn errors into progress. Remember, successful investors aren't mistake-free. They learn and adapt. What past financial choice would you rethink now? Emotions often cloud judgment. After a bad day at work, Raj sold shares impulsively, later regretting it. He now writes down his reasons before any trade, creating a buffer between feeling and action. Simple routines like this build discipline. Finally, avoid comparing yourself to others. Priya envied her friend's crypto gains until that market crashed. She refocused on her own plan, consistent monthly investments. Her portfolio grew steadily while chasing quick wins burned others. Every misstep teaches something valuable. The key is to keep investing, keep learning, and let time work for you. Part 3. The Magic Formula. After learning from past errors, it's time to explore a straightforward method for selecting investments. This section reveals a practical approach used by successful long-term investors, focusing on fundamentally strong businesses available at reasonable prices. You'll discover how to identify these opportunities using 2 clear criteria, without complex calculations or financial jargon. Through relatable stories, we'll demonstrate how this method works in real life and how you can apply it immediately, whether choosing individual stocks or funds. This strategy prioritizes patience over excitement, helping you build wealth steadily while avoiding common traps. Imagine you're shopping for a used car. You'd want one that runs reliably, good quality, and is priced below market value, a bargain. Investing follows the same logic. The magic formula involves 2 simple filters. First, find companies earning high profits relative to their operational costs, indicating efficiency. Second, ensure their stock price is low compared to those earnings, suggesting undervaluation. Together, these signals highlight businesses poised for growth that the market has overlooked. Think about your favorite local cafe. If it's packed daily yet selling for less than similar shops, that's the idea. Carlos, a high school teacher, applied this method. He noticed Brighttech, a company making energy-efficient light bulbs. Research showed Brighttech earned $15 for every $100 invested in operations, well above industry averages. Its stock price was $50 per share, while annual earnings were $5 per share, meaning he'd effectively get a 10% return on earnings alone if prices stayed stable. Carlos bought shares during a market dip when others panicked. 5 years later, Brighttech's consistent performance doubled his investment. What overlooked business in your community might fit this pattern? This strategy works because it ignores short-term noise and targets durable value. Companies excelling in both metrics often rebound strongly after downturns, as their underlying strength outlasts temporary setbacks. Studies of stock performance over decades show portfolios built this way typically outperform flashier, high-risk alternatives. For most investors, though, picking individual stocks demands significant research. A simpler alternative is choosing low-cost index funds focusing on value stocks, which bundle hundreds of such companies automatically. Platforms like Vanguard or Fidelity offer these with minimal fees. To start, use free stock screeners like those on Yahoo Finance, filtering for high return on capital and high earnings yield. Begin with small investments in familiar industries, perhaps a grocery chain you admire for its busy stores and low prices. Track your picks quarterly, but avoid frequent changes. The formula relies on time to compound gains. If research feels overwhelming, allocate most funds to a value-oriented index fund and experiment lightly with individual stocks. How might your perspective shift if you viewed investments as long-term business partnerships rather than lottery tickets? This approach transforms investing from overwhelming to manageable. By concentrating on two concrete indicators, you bypass hype and make decisions grounded in evidence. Carlos's story illustrates how ordinary investors succeed not through brilliance, but discipline. In our next section, we'll explore how acknowledging incremental progress sustains motivation through market cycles, reinforcing that true wealth grows gradually through consistent, informed choices. Part 4. Celebrate the slow wins. Consider the oak tree. It doesn't rush its growth. Each ring forms slowly, season by season. Investing shares this quiet rhythm. Carlos, whom we met earlier, didn't become wealthy overnight. His disciplined approach, regular contributions to his index fund ignoring market noise, created tangible results only after years. 5 years in, he reviewed his statements. Though individual months showed little change, the cumulative growth surprised him. His initial £50 monthly investments had quietly multiplied. How might your own small, consistent actions accumulate like Carlos's? Priya faced a common challenge: impatience. After her first year investing, she felt discouraged seeing minimal gains. She nearly abandoned her strategy when a friend boasted about risky cryptocurrency profits. Instead, Priya reviewed her progress journal. She noted milestones, consistently investing £100 monthly, learning to ignore sensational headlines, and avoiding impulsive trades. This reflection shifted her perspective. She began celebrating each automated deposit as a win. Tracking these small victories helped her recognize genuine progress invisible in daily fluctuations. Scientific studies support this approach. Researchers found that investors who journal their financial journey, not just balances, but behaviors, stay committed 73% longer during downturns. The act of recording transforms abstract numbers into personal stories. Try this. Each month, note one investing decision you're proud of alongside your balance. Did you research before buying? Resist selling during a dip? These choices form your financial backbone. Market history offers powerful perspective. Imagine investing £1,000 in a global index fund in 2010. By 2020, it might have grown to £2,490 despite recessions and crises. But this growth wasn't linear. 13 months showed double-digit losses. 47 months saw negligible gains. Only through compounding did the upward trend emerge. This mirrors Kofi's experience. He set calendar reminders to review his portfolio quarterly, not to change anything, but to acknowledge time passing. Each reminder became a small celebration. Another 3 months of staying the course. Avoid comparison traps. Social media amplifies others' apparent successes while hiding their struggles. Ravi learned this when a colleague's stock tip backfired spectacularly, a fact never shared online. Instead, Ravi focuses on his personal milestones. When his portfolio reached £10,000 after 4 years, he treated himself to a favorite meal. The ritual wasn't about the money itself, but honoring his consistency. What non-monetary reward could mark your next milestone? Practical step: create a progress jar. Drop in a coin whenever you stick to your investment plan during market fear. Increase your monthly contribution by £5. Learn a new financial concept. When the jar fills, use it for something meaningful. This makes abstract progress tactile. True wealth resembles a stone arch. Each modest, regular investment is a carefully placed stone. Initially, they seem disconnected. But as the structure grows, they interlock, creating enduring strength. The final stone, retirement, a home purchase, only holds because countless small stones preceded it. Carlos, Priya, and Kofi succeeded through steadfastness, not speed. Their greatest skill? recognizing that a 50-pound deposit today is equally as vital as the 50,000 pounds it may become tomorrow. Chapter 4, Your Wealth, Your Way. Part 1, Investing in What You Know. The best investment ideas are often hiding in plain sight. Think about your daily routine, the coffee shop you visit every morning, the app you use to connect with friends, the brand of shoes your kids beg for. These everyday experiences can spark smart investment choices. When you notice a product or service that feels essential, popular, or game-changing, you might be spotting a business with real potential. This approach turns your personal insights into a practical investing edge. It builds confidence because you understand what you're buying into. But remember, even brilliant ideas need balance. Putting too much money in one place is risky. This section shows how to turn your observations into action while keeping your portfolio safe and diversified. Take Leo, a delivery driver in Birmingham. He noticed electric bikes were everywhere. Couriers used them, his neighbors bought them, and rental stations popped up in parks. This wasn't just a trend, it was a shift in how people moved around. Leo researched the company behind his favorite e-bike brand, VoltRide. He saw they had steady sales growth and smart partnerships with city councils. He invested £50 a month in their stock. Over 2 years, his patience paid off as cities pushed greener transport. What products do you rely on daily that feel indispensable? Leo's story isn't unique. Many successful investors began by trusting what they saw firsthand. Consider Priya, a nurse who saw her hospital switch to a new digital record system. Staff found it intuitive, errors dropped, and other clinics adopted it. She bought shares in the software firm, starting with small, regular purchases. Her experience as a user helped her spot quality before analysts did. What changes have you witnessed in your own workplace or community? But Priya didn't stop there. She knew putting all her savings in one tech stock was dangerous, so she split her investments, 20% in that software company, 60% in a low-cost global index fund, and 20% in government bonds. This mix let her benefit from her insight without gambling her future. This invest in what you know strategy works because it builds on familiarity. You're not guessing about abstract markets. You're backing businesses you interact with. If your local bookshop thrives while chains struggle, it might signal a shift toward independent retailers. If everyone at your gym wears the same fitness tracker, that brand could have staying power. What's one business you've personally seen grow or innovate? Still, research matters. Not every popular product means a good investment. Before buying shares, ask, is this company profitable? Does it have competitors? Could trends change? Leo checked VoltRide's financial reports online. A simple step anyone can take. Balance protects you. Imagine if Priya had ignored diversification. If new regulations hit her software company, her portfolio could crash. Instead, her index fund exposure softened any single setback. Think, would you feel comfortable if one stock made up half your savings? Start small. Track companies you encounter in a notebook or app. When something catches your eye, like a toy your niece loves or a cloud service your company adopts, dig deeper. Invest modest sums at first and pair these choices with diversified funds. This way, your knowledge fuels growth while broad investments shield you from surprises. By blending personal insights with sensible diversification, you turn everyday awareness into investment wisdom. It's not about predicting the future. It's about recognizing value in what you already understand. Part 2. Building your personal plan. Now that you've started spotting opportunities in what you know, it's time to build your personal investment roadmap. Think of this as your financial GPS. It doesn't need to be complicated, but it will keep you moving toward your goals, whether that's buying a home, funding retirement, or creating security. This section walks you through 3 practical steps: defining your targets, picking the right tools, and deciding what you can comfortably set aside. You'll see how ordinary people craft plans that fit their lives with room to adapt as things change. Let's build something real together. Imagine Lena, a graphic designer who loves hiking. After noticing outdoor gear brands thriving during her trips, she invested small amounts in a few companies. But without a plan, her portfolio felt scattered. She sat down and asked, "What am I really saving for?" Her answer? A cabin in the mountains within 15 years plus retirement security. By naming these, she shifted from random bets to purposeful choices. What does financial success look like for you in 5 years? Be specific. A down payment, no credit card debt, or steady dividends? Short-term goals under 5 years often suit safer options like savings accounts, while long-term dreams 10-plus years can handle growth-focused tools. Lena realized her cabin fund needed steady growth while retirement required decades of compounding. Next, Lena matched her goals to simple tools. For the cabin, she chose a low-cost index fund tracking outdoor recreation stocks, combining her passion with diversification. For retirement, she picked a broad market index fund, spreading risk across hundreds of companies. Ravi, a teacher saving for his daughter's education, took a different path. He used automatic monthly transfers into a tax-advantaged education fund, starting with just £50. His tool matched his goals timeline, 18 years, and his comfort with slow, steady growth. If you had an extra £100 a month, where would it make the most difference toward your goals? Remember, complexity isn't sophistication. Lena and Ravi avoided flashy, high-fee products because evidence shows simple, low-cost options often outperform over time. Deciding how much to invest starts with honesty, not sacrifice. Lena calculated her essential expenses, then set aside 10% of her freelance income, sometimes £200, other months £50. Consistency mattered more than the amount. Ravi started with 5% of his salary, increasing by 1% yearly. Both used pay-yourself-first automation, so money moved before they could spend it. One challenge? Lena worried it wasn't enough, but she recalled a story from a Vanguard study. Someone investing £100 monthly for 30 years at 7% average returns would build over £120,000. Small sums grow significantly with time and compounding. How might your investment choices change if your job situation shifted? Both Lena and Ravi built buffers, 3 months' expenses in emergency savings before ramping up investments. This prevented panic selling during rough patches. Your plan is a living document. When Lena got married, she revised her goals to include her partner's dream of starting a bakery. They adjusted contributions temporarily, directing more cash to the business while keeping retirement funds untouched. Ravi did annual check-ins. When his daughter won a scholarship, he redirected funds toward his own pension. Life changes aren't setbacks. They're reasons to refine. Start where you are. Jot down one goal tonight, research one simple tool tomorrow, and set up a small automatic transfer by week's end. Like Lena and Ravi, you're not chasing perfection. You're building momentum. What small step can you take this week to bring your plan to life? Part 3. Staying the course. Creating a lasting investment plan requires grit. Markets shift, personal circumstances evolve, and fear whispers to abandon strategy. Yet history proves that consistency through uncertainty builds real wealth. This section offers practical tools to maintain focus when doubts arise. You'll discover how ordinary investors weathered storms by sticking to core principles, along with adaptable tactics for navigating life's surprises without derailing progress. True wealth grows not from perfect timing, but from steady commitment refined by experience. Markets inevitably fluctuate. Consider 2020's sudden crash. Global indexes plunged 30% in weeks. Amira, a graphic designer, saw her retirement fund shrink drastically. Panic urged her to sell everything. Instead, she recalled her 20-year timeline and held firm. Within 18 months, her diversified portfolio recovered fully and grew further. Had she sold at the bottom, those losses would have been permanent. Market downturns aren't failures, they're temporary phases. What past challenge taught you that setbacks often precede growth? Life events test resolve too. When David's restaurant closed during pandemic restrictions, he paused new investments but maintained existing ones. He avoided draining his index fund account, instead trimming daily expenses. This balance allowed his money to keep compounding while he rebuilt his business. Automatic transfers simplify consistency. When investments happen without daily decisions, emotion loses its grip. Set contributions to continue regardless of market news. Periodic reviews prevent stagnation without triggering impulsive changes. After adopting twins, Fatima reassessed her plan annually. She reduced stock exposure slightly for stability but maintained her core strategy. Her adjustment days involved checking allocations against new priorities, not chasing trends. Like tuning a bicycle during a long ride, minor calibrations maintain momentum. Have you scheduled your next portfolio check-in? External noise amplifies doubt. Endless financial media highlights daily crises, making small portfolio dips feel catastrophic. Carlos muted investing apps on his phone, checking quarterly instead of hourly. He replaced financial news with books on economic history, recognizing that every generation faces unprecedented turmoil. This perspective helped him ignore short-term chaos. Resilience compounds like interest. Elena started with just £50 monthly into low-cost funds during the 2008 crash. 15 years later, her consistency through multiple downturns built surprising wealth. Her secret? She visualized market drops as clearance sales, opportunities to buy more for less. Small, regular actions build unshakable habits. When motivation fades, systems prevail. Plans mature through seasons. Young investors like Ben can embrace more risk for growth, while those nearing retirement like Hannah might prioritize capital preservation. Both succeed by matching strategy to life phases, not abandoning the path. If you lost your job tomorrow, what one non-negotiable would keep your investments intact? Flexibility within discipline creates lasting progress. Part 4. Passing it on. Imagine the quiet satisfaction of seeing someone you care about take their first confident step into investing. You've navigated market ups and downs, learned through experience, and built habits that grow your wealth. Now that knowledge becomes a gift. Sharing what you know lifts others and strengthens your own understanding. This section explores how passing on your investing insights creates ripples of financial empowerment. You'll see how ordinary people spark change simply by talking openly about money. We'll look at practical ways to start these conversations and the surprising benefits for everyone involved. Let's explore how your journey can light the path for others. Think about Ravi, who learned to invest small amounts regularly from his colleague Omar. Omar shared simple strategies over coffee breaks, things like setting up automatic transfers into low-cost funds. Inspired, Ravi started his own plan. A year later, Ravi felt confident enough to explain the basics to his younger sister Priya. He showed her his investment statements, the small but steady growth visible even with modest contributions. Priya, initially hesitant, opened her first investment account. She recently texted Ravi a screenshot of her first dividend payment. Who could you guide through their first investment step? Sharing doesn't require expertise, just willingness. Consider the power of learning together. Lena and two friends, tired of feeling lost about money, formed a casual monthly group. They met online, each sharing one useful article or a personal win, like resisting an impulse buy to add to their investment pot. They discussed challenges openly, like market dips causing worry. This support helped them stay committed. Soon, Lena's cousin joined, then a neighbor. Their small circle became a source of shared confidence and accountability. What common goal could you explore with peers? Groups make complex topics less intimidating and progress more visible. Teaching clarifies your own thinking. Explaining compound interest to a friend forces you to strip it down to its essence. You might say, it's like your money earning its own money over time. A small start grows bigger because the earnings get reinvested and earned too. This process often reveals gaps in your own knowledge, prompting you to learn more. Omar found that answering Ravi's questions made him review his own strategy, leading him to optimize his fund choices. How might explaining a concept solidify it for you? Mentorship is a two-way street. Small actions spark big changes. Take Kofi, a barber. He started casually chatting with clients about setting aside just £5 a week. He shared his own story of starting late but seeing results. One client, Marcus, opened a junior ISA for his daughter after hearing Kofi. Marcus later told Kofi how that small habit gave him hope for her future. Kofi didn't give formal advice. He shared his experience. This openness builds a culture where money talk isn't taboo but empowering. What's one simple investing win you could share this week? Your journey holds immense value for others. Seeing someone like them succeed makes investing feel possible. When Maya paid off her debt and began investing, she documented her steps honestly on a local community forum. The doubts, the small milestones. A single mother, Anya, read Maya's posts and messaged her, feeling less alone. Maya offered encouragement, not solutions. Anya started her own micro-investments, transforming fear into control. This ripple effect, Omar to Ravi, Ravi to Priya, Maya to Anya, builds collective resilience. Who needs to hear your I started here story? Authenticity inspires more than perfection. Your call to action is simple. Share one insight. Talk about automating savings, show a chart of long-term growth, or admit a past mistake. Offer encouragement, not pressure. By doing this, you reinforce your own commitment and help build a community where financial growth is shared, not hoarded. Imagine the cumulative impact if everyone who learns passes it on. Start today. Who will you empower next?